What if I told you the global economy, the very foundation of your job, your savings, your home, was brought to its knees not by a war, not by a natural disaster, but by a single, pervasive human emotion? Greed. Pure, unadulterated, systemic greed. And it wasn't just the greed of a few rogue traders in some shadowy back room. It was greed baked into the DNA of the entire financial system. Greed that was encouraged, rewarded, and protected by the very rules meant to keep us safe. We all remember the images: Lehman Brothers collapsing, AIG begging for a bailout, families losing their homes. We were told it was a perfect storm, a complex accident no one could have predicted. But what if that's a lie? What if the storm wasn't perfect? It was engineered? What if the warning signs weren't just missed? They were ignored because the money was too good. Today, we're going to pull back the curtain on the 2008 financial crisis. We'll trace the toxic trail of greed from quiet suburban streets to the gilded towers of Wall Street, revealing how a system designed to allocate capital became a machine for extracting wealth and shifting risk onto the most vulnerable. And the most chilling part? The blueprint for disaster. It's still being used right now. Stick with me, because understanding how greed crashed the world isn't just history. It's the key to seeing the next crisis coming. To understand the crash, we need to understand the world before the crash. The late 1990s and early 2000s felt stable. After the dot-com bubble burst, the Federal Reserve, led by the revered Alan Greenspan, slashed interest rates to near zero. Cheap money flooded the system. This wasn't just policy. It was an invitation to borrow, to spend, to invest. And nowhere was this invitation more enthusiastically accepted than in the American housing market. For decades, owning a home was the bedrock of the American dream. But in this new era of cheap credit, it became something else, a speculative asset. Prices weren't just rising, they were skyrocketing, seemingly defying gravity. The belief took hold, a belief actively promoted by lenders, real estate agents, and even government officials, that home prices only go up. It felt like a law of nature. Why save for a down payment when you could get a loan for 100%, maybe even 120% of the home's value? Why worry about your income when lenders offered teaser rates that started low but could explode later? But here's the twist most people missed. This wasn't organic growth. It was fueled by a revolution happening far from Main Street, deep within the financial engineering labs of Wall Street. The old model, a local bank makes a loan, holds it on its books and profits from the interest, was being dismantled, replaced by something far more complex, far more profitable, and far more dangerous. They called it securitization, and it was the engine of the coming disaster. So, what is securitization? Imagine you're a mortgage lender. You make a bunch of home loans. Instead of waiting 30 years to get your money back plus interest, you bundle hundreds or thousands of those loans together into a single package. You then slice this package into different pieces, called tranches, and sell them off to investors, pension funds, hedge funds, foreign banks, as bonds. These were called mortgage-backed securities, MBS. The genius, or the fatal flaw, was in the slicing. The senior tranche got paid first from the mortgage payments, making it seem super safe, worthy of the highest credit rating, lecture, the same as U.S. Treasury bonds. The mezzanine tranche got paid next, riskier, so a lower rating. The equity tranche got paid last, absorbing the first losses, so it was junk-rated but offered high returns. Investors, hungry for yield in a low-interest rate world, gobbled up those A&A-rated slices, believing they were as safe as government debt. But here's where greed entered the equation, fundamentally corrupting the system. In the old model, the lender had skin in the game. If the borrower defaulted, the lender lost money. They had a strong incentive to lend responsibly. Securitization broke that link. The lender, often a mortgage broker working on commission, made their money the moment they originated the loan and sold it off to the Wall Street firm creating the MBS. Their incentive wasn't to ensure the borrower could repay. It was to originate as many loans as possible, as quickly as possible. Quality? That was someone else's problem. And the regulators? They were asleep at the wheel, or worse, actively clearing the path. Landmark deregulation in the late 90s and early 2000s, repealing the Depression-era Glass-Steagall Act that separated commercial and investment banking and explicitly banning regulation of complex derivatives like credit default swaps, CDS, created a Wild West. Wall Street wasn't just playing by different rules, it was writing the rules itself. The stage was set. The fuel was cheap money and deregulation, the spark. The relentless commission-driven push to lend to anyone who could fog a mirror. Enter the subprime borrower. These were individuals with poor credit histories, low incomes, unstable jobs, people who, under traditional lending standards, would never qualify for a mortgage. But in this new world of originate to distribute, they became Wall Street's golden geese. Why? Because subprime loans carried much higher interest rates. More interest meant more cash flow for the MBS, meaning higher potential returns for investors, and fatter fees for everyone in the chain. Lenders got creative, or predatory. Ninja loans, no income, no job, no assets. Option arms, where borrowers could choose to pay less than the interest owed each month with the difference added to the principal, negative amortization. Stated income, or liar loans, where borrowers just said how much they earned, no proof required. The documentation was often laughable. One famous example: a loan application listing the borrower's occupation as migrant farm worker with an annual income of $500,000. It was approved. And Wall Street? They weren't just packaging these toxic loans, they were actively demanding more. Investment banks like Goldman Sachs, Lehman Brothers, and Bear Stearns pressured mortgage originators to churn out ever riskier loans to feed their insatiable MBS machines. The ratings agencies, Moody's, S&P, Fitch, played a crucial and deeply conflicted role. They were paid by the banks to rate these complex securities. Guess what? They kept slapping those coveted étalé ratings on tranches stuffed with subprime garbage. Why? Because if they didn't, the banks would take their business to a competitor who would. It was a race to the bottom, fueled by fees and the illusion of safety. The numbers are staggering. Subprime mortgage originations ballooned from about $100 billion in 2001 to over $600 billion in 2006. Trillions of dollars of these MBS, and even more complex derivatives built on top of them, like CDOs, collateralized debt obligations, which repackaged the riskiest slices of MBS into new securities that somehow also got LAA ratings, flooded global markets. Pensions in Norway, banks in Germany, towns in Italy, they all held pieces of the American housing bubble, believing them to be safe, solid investments. The entire global financial system was now interconnected through this web of toxic debt, held together by faith in inflated ratings and the belief that U.S. home prices would never fall nationally. But bubbles always burst. The trigger was inevitable: rising interest rates. The Fed, worried about inflation, started hiking rates in 2004. Those teaser rates on adjustable rate mortgages, ARMs, began to reset, upwards, dramatically. Suddenly, borrowers who could barely afford the initial low payment were faced with payments they simply couldn't make. Defaults started to tick upwards. At first, Wall Street dismissed it. A little softness in the subprime sector, they called it. But the rot was deeper than anyone admitted. Because the MBS and CDOs were so complex, no one truly understood where the risk was concentrated or how much exposure different institutions had. The first major crack appeared in June 2007. Two hedge funds run by Bear Stearns, heavily invested in subprime MBS, collapsed. Panic began to ripple through the markets. Lenders started getting nervous about lending to each other. Why? Because no one knew who was holding the toxic assets. This is where the credit default swap, CDS, that unregulated derivative banned from oversight in 2000, became a weapon of mass financial destruction. A CDS is essentially an insurance policy against a bond defaulting. But crucially, you didn't need to own the bond to buy the insurance. You could bet against it. And firms like AIG, the giant insurance company, sold hundreds of billions of dollars worth of CDS protection on MBS and CDOs, collecting fat premiums, convinced the underlying assets would never default en masse. They saw it as free money. They were catastrophically wrong. In March 2008, Bear Stearns, once a titan of Wall Street, faced a run on the bank, not by depositors, but by its counterparties refusing to lend it money overnight. The Fed, terrified of systemic collapse, orchestrated a fire sale takeover by J.P. Morgan Chase, backed by $30 billion of taxpayer money. It was a massive bailout disguised as a rescue. The message was clear. Some institutions were too big to fail. But it wasn't enough. The underlying rot was spreading. Then came September 2008. The perfect storm hit. Lehman Brothers, burdened by toxic real estate assets and unable to find a buyer or sufficient government backing, filed for bankruptcy on September 15th. It was the largest bankruptcy in U.S. history. Chaos erupted. The commercial paper market, where companies borrow for short-term needs like payroll, froze. Money market funds broke the buck, meaning their value fell below $1, shattering the illusion of safety for trillions in supposedly ultra-safe investments. AIG, facing demands for collateral on its CDS contracts it couldn't meet, was hours from collapse. On September 16th, the Fed stepped in with an $85 billion loan to AIG, a direct massive bailout of a private company using taxpayer money to cover its reckless bets. The dominoes were falling. Merrill Lynch, fearing a Lehman-style fate, sold itself to Bank of America. Washington Mutual, the largest savings and loan, failed. Wachovia was sold. The entire global financial system teetered on the brink of a second Great Depression. Confidence evaporated. Credit stopped flowing. Businesses couldn't borrow to operate. Consumers stopped spending. The real economy was about to be crushed by the financial sector's greed. The immediate response was unprecedented government intervention. Treasury Secretary Hank Paulson and Fed Chair Ben Bernanke, initially reluctant to bail out Lehman, now pushed for a massive rescue package, the Troubled Asset Relief Program, TARP. Congress, after initial rejection causing market panic, approved $700 billion in October 2008. The money was used to buy toxic assets, though mostly it ended up as capital injections directly into the biggest banks, and bail out AIG, auto companies, and others. Here's the bitter pill. The institutions whose reckless greed caused the crisis were the very ones rescued with public funds. Executives who presided over the disaster often kept their jobs and in some cases even received bonuses funded by the bailout money. Meanwhile, the human cost on Main Street was devastating and long-lasting. Over 10 million American homes were lost to foreclosure between 2007 and 2014. Unemployment soared to nearly 10%. Trillions of dollars in household wealth, primarily in home equity and retirement accounts, vanished. Communities, especially minority neighborhoods targeted by predatory subprime lenders, were decimated. The crisis wasn't just an economic event, it was a profound social trauma that eroded trust in institutions, fueled political polarization, and left deep scars that are still visible today. The Great Recession officially lasted 18 months, but for millions, the recovery took a decade or never fully came. In the aftermath, there was a lot of hand-wringing and promises of reform. The centerpiece was the Dodd-Frank Wall Street Reform and Consumer Protection Act, signed in 2010. It aimed to end too big to fail, increase capital requirements, create the Consumer Financial Protection Bureau, CFPB, to protect borrowers, and bring some oversight to derivatives. But here's the uncomfortable truth. The fixes were incomplete, and the forces of greed and lobbying quickly went to work. Key provisions were watered down or delayed. The Volcker Rule, meant to stop banks from making risky proprietary trades with depositor money, was riddled with loopholes. The too big to fail problem arguably got worse. The biggest banks are now even larger and more dominant than they were in 2008. And the CFPB, a crucial watchdog, has faced relentless political attacks and funding challenges. More importantly, the culture didn't change. The incentive structures that rewarded short-term profit over long-term stability, that prioritized shareholder returns and executive bonuses above all else, remained largely intact. The fundamental belief that complex financial engineering could magically eliminate risk rather than just obscure and redistribute it persisted. We patched the holes, but we didn't rebuild the ship. And that brings us to the most alarming part. The patterns are repeating right now. Look at the signals. The everything bubble, ultra-low interest rates maintained for over a decade post-crisis and then slashed again during the pandemic, have inflated asset prices across the board. Stocks, bonds, real estate, even cryptocurrencies and meme stocks. The S&P 500 has seen multiple years of double-digit returns, fueled significantly by cheap money and corporate stock buybacks, often funded by debt, not necessarily underlying productivity. Total U.S. household debt recently hit a record $69 trillion Q1 2024. Student loan debt alone is over $1. $7 trillion. Credit card debt is soaring past $1. $1 trillion with delinquency rates rising sharply, especially among younger borrowers. Sound familiar? The new subprime. While traditional subprime mortgages are less prevalent, risk has migrated. Look at the explosion of buy now, pay later (BNPL) schemes, often with opaque fees and targeting financially vulnerable consumers. Look at the surge in risky corporate debt. Covenant-light loans that offer lenders little protection if a company stumbles, now making up over 80% of the leveraged loan market. Private equity firms load companies with debt to extract fees, leaving them fragile. It's the same originate-to-distribute, fee-driven model, just repackaged. The shadow banking system and unregulated risk. The crisis exposed the dangers of the shadow banking system, non-bank financial institutions like hedge funds, money market funds, and repo markets that perform bank-like functions without bank-like regulation. This sector has grown massively since 2008 and remains a significant source of hidden leverage and systemic risk. Complex derivatives are still traded, often opaquely. The 2023 collapse of Silicon Valley Bank, SVB, wasn't caused by subprime mortgages, but by a classic bank run triggered by losses on long-term government bonds, assets considered safe, held by a bank that had ignored basic interest rate risk management. The speed of the run, fueled by social media and digital banking, showed how fragile confidence remains. And who was exposed? Major Wall Street banks acting as counterparties, and crucially, the venture capital ecosystem that relied on SVB, another example of interconnectedness and concentrated risk. The parallels are chilling: cheap money fueling speculation, risk being pushed onto the less sophisticated or more vulnerable. Complex financial products obscuring true risk, regulators playing catch-up, a belief that this time is different. The actors have changed costumes, but the script of greed-driven excess followed by painful correction remains the same. The 2008 crisis wasn't an anomaly. It was a symptom of a system inherently prone to these cycles when left unchecked. So, what do we take from this? 3 clear lessons. Greed is systemic, not just individual. The 2008 crisis wasn't caused by a few bad apples. It was the inevitable result of a system where perverse incentives, originating loans for fees, rating securities for payment, selling insurance without capital, were baked into the core. Fixing individuals isn't enough. You must fix the rules of the game. Complexity is often a smokescreen for risk. When financial products become so complex that even the people selling them don't fully understand them, remember the CDO squared, it's a massive red flag. Complexity is frequently used to hide risk, inflate ratings, and extract fees, not to create genuine value or stability. Too big to fail is a moral hazard time bomb. Bailing out institutions without imposing severe consequences, like breaking them up or jailing executives for fraud, guarantees the cycle will repeat. It signals that the upside is privatized, profits and bonuses for executives, while the downside is socialized, losses borne by taxpayers and the unemployed. This isn't capitalism, it's a rigged game. The warning is stark. The financial system remains vulnerable. The pressures of short-term profit, the allure of easy money, and the power of the financial lobby to resist meaningful reform are constant. The next crisis might not look like 2008. It could be triggered by commercial real estate debt, climate-related losses, a crypto collapse, or something entirely unforeseen. But the underlying cause will likely be the same: unchecked greed exploiting systemic weaknesses. So what can you do? First, educate yourself. Understand your own finances, your investments, and the basic mechanics of the system you're part of. Don't trust ratings or promises blindly. Second, demand accountability. Support politicians and regulators who prioritize strong, enforced financial regulations and consumer protections, not those who bow to Wall Street lobbyists. The fight for the CFPB is ongoing. Know who stands where. Third, spread awareness. Share this knowledge. Talk about it. The more people understand how the system really works, the harder it is for the cycle of greed and collapse to repeat unnoticed. The 2008 financial crisis wasn't just a historical event, it's a living lesson, a warning etched in foreclosed homes, lost jobs, and shattered trust. It showed us that when greed becomes the operating system of finance, everyone pays the price, except, all too often, the ones who caused it. The question isn't if the next crisis will come. The question is, will we be awake this time? Will we recognize the signs, and will we have the collective will to build a system that serves people, not just profits? If this deep dive into how greed crashed the world opened your eyes, smash that like button. It tells YouTube this matters. Subscribe and hit the bell for more hard-hitting explorations of the systems that shape our lives. Comment below. What shocked you most about the 2008 crisis? Do you see the parallels today? Let's keep this crucial conversation going. Thanks for watching. Stay curious, stay vigilant,